Welcome to The Explainer. Today, we are going way behind the headlines to uncover the real reason Silicon Valley Bank collapsed. And I'll tell you right now, it's not just a story you probably heard in the news. It goes a lot deeper than that.
Right. So you heard that massive multi-billion-dollar losses on a government bond portfolio were the final spectacular blow. And sure, they were, but that was just the symptom. The true cause? Well, that was a fatal flaw hidden in plain sight deep inside its day-to-day business.
Okay, so let's really dive into this. The story of SVB isn't some crazy tale about a single bad bet. No, it's about these fundamental cracks in its business model, starting with the way it got its money. And those cracks made its failure pretty much inevitable. So, the first half of this ticking time bomb was where SVB got its money in the first place, which is, its deposits. A huge portion of SVB's funding came from what are called non-interest-bearing or NIB deposits. Now, on the surface, this looks like an absolutely genius move. I mean, imagine a bank getting billions and billions of dollars in capital without paying a single penny of interest on it. It's like the ultimate cheap fuel for its engine. And the sheer scale of their dependency was just enormous. Before 2022, a staggering 65% of all deposits at SVB were non-interest-bearing. That is way higher than its peers. They weren't just using free money, they were completely addicted to it. But here's the catch, right? This money wasn't loyal. It wasn't sticky, as they say in the business. It was held by super savvy tech companies and VCs who were totally fine leaving their money there as long as interest rates everywhere were basically zero. But the second the Federal Reserve started hiking rates, that free money suddenly came with a massive opportunity cost. And what's just incredible is that this isn't some outside analysis I'm giving you. This quote is from SVB's own 2022 annual report. They knew. They literally told their own investors that their clients were leaving for better returns. The alarm bells were ringing inside their own house.
And that is exactly what happened. As the Fed hiked rates all through 2022, SVB's cheap funding base just evaporated. The amount of these free deposits plummeted from 65% to below 50% in just 1 year. That money fled for greener, higher-yielding pastures.
Okay, let's flip over to the other side of the balance sheet and see how this gets even worse. Because at the exact same time its free money was disappearing out the back door, SVB had another massive problem with the money it was lending out the front door. Every bank lives and dies by something called its net interest margin, or NIM. It's the bank's fundamental profit engine. You take in deposits at one rate, you lend money out at a higher rate, and that difference, your markup, that's your profit. A healthy bank needs a healthy, stable NIM. Simple as that. But SVB's own IM was consistently and often dramatically lower than its peers. I mean, this chart is basically a visual confession. While the average bank was earning a healthy markup, SVB was struggling to keep up, sometimes trailing by a full percentage point. That's a huge deal in banking. So what does that really mean? Well, the crucial point is that SVB just didn't have pricing power. As this analysis from GPS Global Advisors puts it, they were basically buying their growth by offering cheap loans. They were attracting customers by undercutting the competition, not by having a product that could command a fair price. And this right here, this comparison, it just reveals the trap they built for themselves. See, when interest rates go up, a typical bank just raises its loan prices to make up for its own higher costs. It preserves its margin. But SVB, they couldn't do that. Their entire growth model was based on being the cheapest guy in town. If they raised their prices, their customers would just walk. So their profit margin was absolutely destined to collapse. So now you have these two massive pressures closing in on the bank from both sides, right? Its cheap money was leaving, which forced it to find more expensive funding. But at the same time, its main business of lending wasn't profitable enough to pay for it. That vice was just tightening and tightening. And this created this vicious doom loop. The Fed raises rates, which chases away all their free deposits, but their complete lack of pricing power on loans meant they couldn't generate the extra income they needed to pay higher interest to attract new deposits. They were completely and utterly trapped by their own business model.
And the result of that squeeze? It comes down to this one number, 3. By the end of 2022, long before the famous bank run that you saw in the news, SVB had already suffered 3 straight quarters of deposit outflows. This wasn't some sudden crisis. It was a slow-motion train wreck.
and the business model was visibly breaking down for everyone to see.
So the big thing to take away from this is that the catastrophic bond portfolio, the thing everyone talked about, that was just the final desperate act. It was the symptom of a much deeper disease, a fundamentally flawed business model that just couldn't survive in a normal interest rate environment. The real lesson from SVB's collapse, then, is all about the boring, unglamorous fundamentals of banking. It's a huge warning about the danger of relying on unstable, non-sticky funding. It's about how critically important it is to have actual pricing power, and it proves, once and for all, you cannot build a sustainable business just by being the cheapest provider on the block. And that leaves us with one final, pretty crucial question. SVB's fatal flaws, this flighty deposit base and zero pricing power, they weren't buried in some complex financial instrument. They were right there in its financial statements, hidden in plain sight, which really makes you wonder, doesn't it? Who else out there is built on that same fragile foundation?